Imagine this, you're sitting back on the couch of your home and you're thinking to yourself you'd really like to do some home improvement projects, or maybe you have some bills that are feeling a little daunting right now that you want to pay off. All of a sudden you see a commercial come on that talks about a home equity line of credit, also known as a HELOC. Piques your curiosity and now you want to know, is it right for you? Let's go over some ways about how a home equity line of credit works to help you make a well-informed decision. My name is Andrew Finney and my passion is helping you make sense of real estate. If you need help finding a top agent near you, or if you simply want to drop me a line to say hello, my contact info is below. If you're new here, please go ahead and subscribe to this channel now and like this video. Thank you. Alright my friend, as you can imagine, there's a lot of different pros and cons that go into the considerations of exploring your home equity line of credit options. There are some good things that could happen as a result, and there are some bad things that could happen if you're not prepared. So here's what you're going to learn after our conversation today. The first one is, what is a home equity line of credit? The second one is, how does a HELOC work? The third is, how will this impact your credit score? The fourth are common reasons why people get a home equity line of credit. The fifth are reasons that people avoid getting a HELOC. The sixth is, how can you get the best rate if you choose to get a home equity line of credit? And the seventh is, understand the differences of a home equity loan versus a home equity line of credit. So let's lead in with the first one. What is a home equity line of credit, also known as a HELOC? In short, a home equity line of credit is a second mortgage that in many cases will provide up to 85% of your equity amount in your home. Now, it is important to note the amount that you can draw out of your equity will vary from lender to lender. Make sure that you explore those options with each lender that you're considering having a home equity line of credit with to know how much you can cash out of your property. Now, when we're talking about the 85% that you could get out of your house, it is important to note that we're going to be taking a look at what is the current property value of your house, and then you're looking at 85% of that amount minus your mortgage owed. The difference of what your home is worth to how much is owed on the property is known as your equity. That's the portion they're going to be looking at giving the 85%, or again, it varies from lender to lender. A couple major reasons why people think about getting a home equity line of credit are for home renovation projects or if an emergency situation happens. Yet one of the biggest reasons that people don't get a home equity line of credit is for the simple fact that it is like a second mortgage on your home, and what happens if you can't afford the new payments. To get a home equity line of credit, typically a lender will be looking for you to have a debt to income ratio in the low 40s, if not less, also a credit score of at least 620 or above, and you having a value in your home of 10 to 20% greater than what you owe on your home. These are minimum threshold, and again, it will vary from lender to lender. The best way to explore those options are with a loan officer. So now let's explore, how does a home equity line of credit work? The easiest way to understand a home equity line of credit is to essentially think about it as like a credit card for your house. It's literally like you're saying, oh, thank you, house, you've paid me all this equity and now I'm going to use you like a credit card. Now, we know that credit card usage done incorrectly is not a smart idea. So I always stress to people when they're considering a home equity line of credit to ensure they're making a well-informed decision and explore all financial options prior to touching the equity in your home. That said, let's go over an illustration of how this works. Let's say that your home is worth $500,000 and that you have a mortgage balance of roughly $300,000. And if you can get up to 85% of the value of your home from a specific lender, that would mean that you'd have the potential of $125,000 home equity line of credit. Let's bring this to life with a little bit of math. Take your home that is valued at $500,000, multiply it by 85%, the result is $425,000. Take the $425,000 amount that you could potentially tap into and subtract it from the amount that you owe on your mortgage, which is $300,000. That leaves you with the difference of $125,000. The $125,000 becomes your maximum amount of line of credit that you could get in this example. It is important to note that a lot of home equity lines of credit do have variable interest rates, which means the interest rate could change up or down. To understand more about how that works, please talk it over with your loan officer. Which will take us to the third point. How does a home equity line of credit impact your credit score? Even though your home equity line of credit kind of behaves like a credit card when it comes to your home, different credit bureaus may view this a little bit differently, in the sense that they won't account it as a revolving debt. They may look at it as an installment debt. What that means is that even if you borrow 100% of the total amount available to you through the home equity line of credit, it might not have a negative impact on your credit score. Yet it is important to understand that, like any other line of credit, having a brand new home equity line of credit might dip your credit score slightly in the beginning. Yet it is important to understand that, like any other new line of credit, credit, getting a newer home equity line of credit will likely cause your credit score to reduce, at least in the temporary short-term future. The fourth thing to note is, what are the common reasons why people would get a home equity line of credit? As mentioned early on in our conversation today, there are reasons that this does make sense from time to time. Sometimes it could be for emergency bills. Sometimes it could be used as a college fund for one of your loved ones. Sometimes people will use this for home improvements or renovations when they're getting ready to sell their house. Now, I would strongly urge you that if that is the case, that you want to do home improvements or renovations for the purpose of selling that house, to work with your trusted real estate advisor 1 to 2 years in advance, and to please complete those repairs 1 to 2 years in advance to help you maximize the potential return on those renovation projects. That being said, those are very common reasons why people choose a home equity line of credit. Now, obviously, this isn't going to be a wealth building tactic. All too often, people fall into the pitfalls of saying, oh my God, my house, I can get $125,000 out of my $500,000 house. I want to go splurge this money. I want to go on a shopping spree, a vacation, buy a new vehicle, buy a boat, buy a new car, whatever the case may be. They're not thinking logically and prudently. What's most important at the end of the day? A brand new boat or a roof over your head that keeps you and your family safe? The roof over your head, of course, right? So let's make sure that when you're considering tapping into your home's equity, you really think this through and think through the possible consequences into the future. Just because it's your equity doesn't mean you're not going to have to pay it back when you take it out on a line of credit. The truest and purest way of tapping your home equity without having to pay it back is simply by selling your property. But then that gets you into the position of where are you going to go now, and how much of that money are you going to need for your new move? Only you can answer these questions. All I'm asking you to do is to get real with yourself and understand the reasons why you want to use your home equity line of credit, and think through this logically, playing it out well into the future of how the consequences of this decision could impact you. As a side note, the interest on your home equity line of credit could be tax deductible. Please review that with your tax advisor to see if that's going to be your case too. Now let's take a closer look at 5 reasons that you would not want to have a home equity line of credit. The first one is if your income is unstable. The second one is if you cannot afford the upfront cost of the home equity line of credit. How is the bank going to verify your property's value? You're going to need to have an appraisal done. You'll have an application fee for the home equity line of credit. You may have to have a title search, and you may have attorney fees involved depending on the state that you're in, and any points that might need to be paid to buy down the rate. Review these options closely with your loan officer in mind and get a loan estimate for your home equity line of credit to ensure that you're making the right decision for you. At the same time, if you can't afford these upfront costs, please don't proceed. The third reason not to get a HELOC is if you're not looking to borrow much money. Perhaps getting a signature loan or a loan from your bank would be a little bit easier if you don't need a lot of money, depending on your purpose. The fourth reason is if you can't handle the fluctuating interest rate. Let's say that it goes up tomorrow. Are you going to be able to afford the payment, or did you tap yourself out because you took out too much money, and in between your monthly mortgage and your home equity line of credit, now you're cash strapped? Please don't get into this position. Remember 2008, because yeah, this was one of the variables in that big mess. And the fifth one is a kicker, and that's if you're using your home equity line of credit to meet your basic living needs. You're not going to get ahead if you take out a home equity line of credit, because it might feel like you did because you became cash rich, but at the same time you just increased your debt load. And if the problem is already money, then why would we take out more credit to meet our basic living expenses? In this case, if this is your situation, then it might be time to have the heart-to-heart conversation if it's best to cash out your house by selling your house so you can keep your equity, downsize into a property that is more convenient for you and easier to maintain. Only you can make this decision. All the same, if you use a home equity line of credit to meet your basic living expenses, the very real reality is what happens if you don't have a big change in your financial future. Then what's going to happen is you're only stalling a short sale or foreclosure from happening, as opposed to stopping the bleeding now, making the right decisions for you to pare back and downsize if that's where you are right now in your life. The sixth thing is, how do you get the best interest rate for your new home equity line of credit? Now this one's going to come all on you with the research that you do. Just like watching this video, you're getting more and more educated. Good on you. Please continue to do so. When we're talking about getting a new line of credit or loan, we know that it's going to have a lot to do with your FICO score. So if you need to do some work on your credit report, go ahead and do so now before applying for your home equity line of credit. This one's in your court, and the better your credit score, the better rate you're likely to get. And the seventh thing is understanding the differences between a home equity loan versus a home equity line of credit. Remember that your home equity line of credit kind of behaves like a credit card with a revolving balance, letting you tap into the equity as you need it moving forward. Whereas a home equity loan is going to give you a massive massive lump sum of money at one time. This gets pretty darn risky for a lot of people. So please make sure that you're making the most prudent decision that's right for you. The biggest difference is the home equity line of credit behaves like a credit card. You tap into it as you need it. Home equity loan is that you get one lump sum at one time that's paid back in installment amounts over time. While a home equity line of credit has a variable rate, kind of like credit cards do, it is also important to note that a home equity loan is generally a fixed rate, which can save you a lot of money into the future as well. You'll want to review your options with a local loan officer to ensure that you're making a smart move for you. With all this talk about money, let's take a closer look at 4 ways to talk about money with your partner and how to recover from a financial setback. Looking forward to our next conversation. We'll see you in a few.